The global financial landscape stands at a critical juncture as emerging evidence reveals a staggering $390 billion divestment from U.S. Treasury securities by several of America's closest allies. This sweeping move, occurring between November 2024 and January 2025, is not a mere adjustment in investment strategy. It is a profound signal of shifting global confidence in U.S. fiscal policies and the stability of the dollar. This report delves into the key factors behind this sell-off, examining its historical context, the major players involved, the impact of rising interest rates, and the reverberations of Trump's America First trade policies on both the domestic and international stages. For decades, U.S. Treasury securities have been viewed as a cornerstone of financial stability, a safe haven that has provided reliable returns to nations around the world. The U.S. dollar, as the world's reserve currency, has facilitated international trade and investment by ensuring that surplus funds from major trading partners, including China, Japan, and the United Kingdom, find a productive outlet in these government-backed securities. This arrangement has not only bolstered economic stability but also reinforced diplomatic ties, as holding U.S. debt has historically conferred a measure of influence in global trade negotiations. Key indicators such as the Treasury International Capital Report have long reflected the underlying trust in America's economic stewardship. However, the recent decision to divest $390 billion in U.S. Treasuries signals a seismic shift in this long-standing financial relationship. Such an extensive sell-off implies that global investors are reassessing their commitment to American fiscal policies and the long-term viability of the dollar. This action is more than a simple portfolio rebalance. It portends higher borrowing costs for the United States, intensifies pressure on interest rates, and threatens the enduring dominance of the dollar in international finance. A closer look at the details of this divestment reveals a coordinated strategy among several major players. Between November 2024 and January 2025, foreign governments collectively unloaded nearly $390 billion in U.S. Treasury securities, marking one of the most significant reductions in U.S. debt holdings in recorded history. Notable among these sellers are Brazil, which divested $55.9 billion, and Ireland with $42 billion. The Cayman Islands followed closely with $41.2 billion, while Canada, Norway, and India trimmed their positions by $37 billion, $35.6 billion, and $34.9 billion respectively. Even influential holders such as Japan and China reduced their stakes by $7.8 billion each. The United Kingdom and Singapore also contributed significantly to this trend, cutting back by $26.6 billion and $26.5 billion respectively. This widespread divestment can be attributed to several factors. Primarily, the recent increase in U.S. interest rates has rendered older bonds with lower yields comparatively unattractive. As new bonds are issued with higher returns, investors holding older securities are compelled to exit their positions to reallocate funds toward more profitable opportunities. Additionally, rising geopolitical tensions, exacerbated by Trump's aggressive trade policies, have further eroded confidence in U.S. assets. In response, central banks are actively seeking to diversify their reserves, increasing their holdings in gold and other foreign currencies, thereby reducing their reliance on the dollar as the singular global reserve asset. Central to the current financial turbulence is the impact of rising interest rates. In its ongoing battle against inflation, the Federal Reserve has enacted a series of rate hikes, a move that has introduced a significant challenge for bondholders. When interest rates rise, newly issued bonds offer yields that reflect this change, thereby diminishing the attractiveness of older bonds with lower returns. The market value of these legacy bonds consequently declines, prompting foreign investors to liquidate their holdings and seek alternatives with better yields. Furthermore, a strengthened U.S. dollar, a direct consequence of these higher rates, exacerbates the cost of servicing debt denominated in dollars for foreign nations. This dual pressure has catalyzed a broader reevaluation of investment strategies and has accelerated the shift away from U.S.-centric financial instruments. Amid these developments, President Trump's America First trade policies have played a significant role in reshaping global economic perceptions. The imposition of heightened tariffs on key trading partners, including China, Canada, Mexico, and the European Union, has not only disrupted established trade relationships but has also spurred retaliatory actions that extend beyond tariffs. Several foreign governments, wary of the long-term implications of such protectionist measures, have chosen to decrease their exposure to U.S. debt as a safeguard against economic volatility. The European Union has signaled its intent to counteract by targeting crucial U.S. exports such as agricultural products and automobiles. Simultaneously, China has contemplated imposing severe tariffs on American soybeans and corn, a move that would inflict considerable damage on U.S. farmers and rural communities. In a similar vein, Canadian authorities, under the leadership of Prime Minister Mark Carney, have outlined plans to dismantle internal trade barriers and introduce countermeasures estimated at up to $125 billion, aimed directly at U.S. exports. These retaliatory measures underscore a growing consensus among international players. America's current fiscal and trade policies are prompting a strategic realignment. As nations increasingly diversify their reserve portfolios, the traditional dependence on U.S. Treasuries as a cornerstone of financial stability is diminishing. Central banks in emerging and established economies alike are incrementally bolstering their gold reserves and rebalancing their portfolios to include a wider array of currencies. This diversification strategy, if sustained, has the potential to erode the dollar's long-standing dominance on the global stage, leading to higher inflation and increased costs for imported goods in the United States. The long-term implications for the U.S. economy are profound. The sell-off of $390 billion in treasuries comes at a time when the national debt has already exceeded $35 trillion, a figure fueled by extensive government spending, significant tax cuts, and elevated defense budgets during the Trump administration. Federal Reserve Chairman Jerome Powell has cautioned that such high levels of debt, when coupled with rising interest expenses, could undermine the economic stability of the nation. With a larger portion of the federal budget earmarked for interest payments, there is less fiscal space available for vital infrastructure projects and public services. A continued decline in foreign demand for U.S. debt securities is likely to push bond yields higher, thereby increasing borrowing costs for both the government and the private sector. This scenario could precipitate a cascade of economic challenges, including higher mortgage rates, more expensive business loans, and a general slowdown in economic growth. Moreover, the domestic repercussions of Trump's tariff policies extend well beyond the sphere of international finance. Higher tariffs mean increased costs for imported components, a reality that could translate into price hikes for finished goods such as automobiles, potentially ranging from $1,500 to $3,000 per vehicle. Such price increases would not only dampen consumer demand but could also lead to significant job losses in manufacturing-intensive regions. Similarly, retaliatory tariffs imposed by trade partners may lead to reduced demand for American agricultural exports, thereby creating a surplus supply and driving down prices for U.S. farmers. These interconnected challenges form a complex tapestry of financial and political risks that underscore the urgent need for a reassessment of current economic policies. In conclusion, the $390 billion divestment from U.S. Treasuries is emblematic of a broader crisis of confidence in America's fiscal and trade strategies. The coordinated sell-off by major global players, driven by rising interest rates, escalating geopolitical tensions, and the repercussions of Trump's America First trade policies, signifies a pivotal moment in international finance. This trend not only jeopardizes the affordability of U.S. debt financing but also threatens to diminish the global preeminence of the dollar. As the United States grapples with burgeoning debt and shifting investor sentiment, the nation finds itself at a crossroads where financial prudence must confront political imperatives. The pressing question now remains: can the United States recalibrate its economic policies to restore global confidence? Or are we witnessing the inception of a long-term realignment away from American financial dominance? The answer to this question will have far-reaching implications for both domestic prosperity and the global financial system. As nations continue to adapt their investment strategies and reorient their economic alliances, the future of the U.S. economy will depend on its ability to navigate these turbulent waters with strategic foresight and measured reform. This report has provided an in-depth examination of the factors precipitating the current financial realignment, the significant role played by foreign divestments, and the cascading impact of domestic trade policies. The road ahead is fraught with uncertainty, but one element remains clear: the global economic order is evolving, and the decisions made today will shape the financial landscape for decades to come.